Welcome back. With our next panel, we're going to discuss now the economic scars of COVID-19 in Latin America. We have four really top speakers today. I'm going to spend very little time introducing them because everybody knows who we're talking about. We have here today Ilan Goldfajn. He's the chairman for Credit Suisse in Brazil. Shetty, managing director of Fitch Ratings. Gerardo Rodriguez, managing director at BlackRock. And Shantall Tegho, managing director of Goldman Sachs. Thank you, everybody, for joining us for this conversation for the next hour. I was thinking in starting and framing this conversation on the topic of inflation, obviously. Doing a bit of the research, we can see in the Bloomberg terminal that Latin America is going to have not only this year, but also next year, the highest rates of inflation in the world. We are close to 12% this year. It's going to slow down a little bit to 11% next year. And this, obviously will have massive repercussions for the economy, for politics, for markets, for investors. I want to start asking Ilan about this, and if you can give us a little bit of historic perspective, where we are now, how bad is this inflation spike that we're seeing everywhere, right? Like we're seeing it all around the world, but it's worse, much worse here in the region.
Hi, thank you for the question. It's a pleasure to be here. Hi to my colleagues. It's always good to be in good company. You asking about inflation. What we're seeing today is a spike in inflation. It's a post-COVID spike that countries in the region would like to say that this is basically an imported inflation. It's coming from commodities, a global phenomena, and basically the region is just suffering from that. However, I believe that inflation is not only foreign made. I think countries have generated also their part of the inflation. In the case of Brazil, for example, I think we have seen a bit of expansionary policies, both fiscally, but also monetary. So I would say that the questions we are having globally, whether this is temporary, whether this comes from just a COVID reaction and it will eventually fade, or whether this is very expansionary monetary or fiscal policies that after a long time of calm markets and calm inflation, finally we're having a spike. In the past, since you asked me about historic perspective, I don't think we are back to where we were. I mean, unfortunately, I'm old enough. I remember the 80s, remember the 90s. This was a completely different inflation. This was out of control inflation. That was either hyperinflation or inflation that was running away because you had to monetize fiscal deficits. There was no control, no budgets, no real data. And I think beginning of the 90s, mid-90s in Brazil was the real plan. You ended up controlling it. It was a period of quite a bit of capital flows. So the exchange rate was an instrument that most countries use as an anchor. Then you had the crisis coming later because you used too much of this anchor. And finally, you swap the exchange rate to an inflation targeting regimes where you had more flexibility. And we must say that a bit of the control of inflation in the last 10, 20 years was also due to very subdued inflation globally, almost no inflation. And that, of course, helps locally. Of course, again, even in that direction, it was not only foreign-made disinflation, it was also inflation targeting, better fiscal controls. So In the way down, there was some merit to monetary policy and fiscal policy in Latin America and emerging markets. And now, again, it's not only foreign made inflation back, it has also been our mistakes in Latin America.
Shantall, give us a little bit the global perspective here. What is the Fed doing? We saw Pablo saying, no transitory anymore, or, the different definition of transitory. How are you seeing all this?
Thank you, Juan Pablo. And I agree with Ilan, it's going to be complicated and uncertain, but let me try to provide some guidance on the US inflation path from here. And just as a reminder, we will get inflation data for the US this coming Friday, and we are expecting headline inflation to increase to around levels of 6.8% and core to be around 4.9%, so pretty elevated. But let's take a very quick deep dive. When we look at headline CPI this year, every single component faced very aggressive increases. But from here onwards, it's going to be mostly about core inflation. And within non-core inflation, our base case scenario is for flat energy prices for 2022. But when we think about core inflation, we think there are two questions to ask. First, how fast will goods inflation come down from here? And second, how fast will services inflation increase from here? Now, the answer to the goods inflation question is that the disinflationary process will start, but not right away. For example, we still expect to see a few more months with elevated inflation within used cars. And it will probably also continue for new autos, because developments on this category very much depend on the outlook for semiconductors, and we still do not know when supply chain issues are going to be resolved, and we think it's still going to take a little bit of time from here. So in a nutshell, we still expect to see a few more months of elevated goods inflation. Now, the answer to the services inflation question is that all leading indicators are pointing towards a substantial pickup in the 12-month change, and even the monthly change has already started to pick up in both September and October. And we expect this to continue for the foreseeable future in rent prices and OER. And so as you are listening to all this, you're probably questioning, how will everything look a year from today? And we're still operating with a lot of uncertainty, as I mentioned in the beginning, but I would say that we're still going to be in a situation in which there are supply constraints, and therefore by adjusting aggregate demand by a little bit, we are likely to see a bigger reaction in prices than in output. This means that we could end in a positive scenario in which the Fed was able to tame inflation without having a large effect on growth. And with regards to the region, I would just mention that we do not see inflation coming down materially, and we think that the big center of inflation in the region will remain elevated. And this is why our focus is on services inflation all across, because it's going to be stickier and it's going to give us more of a sense about the trend in inflation going forward.
Thanks, Shantall. And it's very interesting that you see almost 7% inflation in the US. I think a few months ago, nobody would have expected that. That's typical, not even in the region, of course. Gerardo, despite all this, what the market and the Treasury's curve is telling us is that investors in the long run, they're not worried about this. How you read, the flattening that we saw in the curve lately, and this idea that the Fed can step in now?
Not only rates markets, Juan Pablo, financial markets across the board are looking through these short-term inflationary pressures. Shantall already described sort of the nature of the shock, which is, like, for the most part, supply related, not much to do in the short term from a policy reaction function perspective. The Fed has been signaling that they're also sort of looking through these dynamics. And one thing that has not been mentioned yet is the secular dynamics that have been very persistent over the past 20 or so years that have been sort of reducing inflation across the board around the world. So the one channel that we've been focusing on for the most part is the potential effect that higher inflation rates, because the level of inflation that we're observing, we hadn't seen in a while. Now, what this may influence is political dynamics in different countries. There's a lot of talk around the US midterm elections and what's going to be sort of the role of inflation in this. In the short term, we're likely to see higher inflation prints across the region. And that is something that, because of historical reasons that Ilan was mentioning, it is in the back of the mind of voters. It is in the back of the mind of politicians. And if anything, we are seeing extreme politics in the region. This is something that may be used against politicians that are currently governing. So that's an aspect that perhaps has been a bit under the radar, and it is an angle that we're paying attention to.
We're going to go back to, obviously, this very important point of politics when we discuss a little bit the electoral schedule. But Shelly, give me the perspective of the credit ratings, right? How is all this inflation affecting debt, affecting the standing of the credit position of these countries?
Yeah, I mean, I think that, first of all, thank you for having me, and great to be with such great panelists. So yes, Juan Pablo, I mean, I think what we've heard is that this is sort of pretty uniform story, right? You're seeing inflation in advanced economies. We've talked about the US. We're obviously seeing high inflation pressures in the region. But, you cannot really equate sort of the high inflation in the US with, what you see in Latin America or emerging markets in general. I think in Latin America, you really have to grapple with several more layers. Once you have inflation, which is already high, it becomes more difficult in Latin America to actually reduce it. The transmission channels are also very different. In some countries, the local markets are shallower. Latin American countries have to deal with depreciation and volatility. There's this perceived independence of central bank issue in some of the countries, and also. What we are not really seeing this time around is higher commodity prices that we've seen has not been really accompanied by currency appreciation in the region either. So that's exacerbating in some cases the shock, expansionary policies that Ilan already talked about in Brazil, but some other countries as well. So it's a much more complicated kind of picture, so you may have some common threads, global inflation like energy and commodity prices, but there are certainly domestic pockets which are also affecting inflation. Now, how this is incorporated in the rating, one thing I would say that, obviously if we see persistently high inflation, then we think that does bring net cost to the economy, including heightened growth volatility or broader macro financial stability risks. Clearly, countries which have higher inflation for a longer period of time, you start seeing indexation taking hold. Dollarization becomes an issue in some of the countries. So it's certainly not good news for rating fundamentals. And we actually incorporate inflation numbers very directly into our sovereign rating model. We do kind of look at 3-year inflation numbers, so we try to smooth out the impact, as well. But also on a qualitative basis, we look at what has been the central bank's response to controlling inflation, for example. So if we might make negative notch adjustments on a qualitative basis if we see monetary authorities are not able to control the inflation dynamic for whatever reason that actually goes against credibility of that central bank. Now, so far, we've not really taken any negative rating actions in Latin America because of inflation per se, partly because we do think, yes, inflation is high right now. We are seeing central banks reacting to varying degrees, and we do expect inflation to begin to come down, especially towards the second half of next year.
Now, it's interesting. You are also, Gerardo mentioned this idea of the independence of the central bank. And what we saw in Latin America is that unlike what the Fed and the ECB and obviously the Bank of England have done, in Latin America, central bank have rushed to increase interest rates, right? I counted at least, I think, more than 20 increases since Brazil started in March. Brazil is going to do it again tomorrow, Peru as well. So, Ilan, I want to ask you you said there are components that are domestic in this inflation. How effective is this rush to increase interest rates, looking at what the US and the ECB have done?
I believe that central banks in the region have a responsibility to act, given that they are mostly inflation targeting. I mean the big regimes, and they cannot just ignore their targets for this year, for next year. So they somehow are pressed to react. Of course, the perception that is they need to react sooner than later has to do with your first question, historical. I mean, nobody will take risks. If you have a view that is 50% possibility that's temporary, 50% probability that's more persistent, more permanent, you'll just not wait. You'll say, well, let's just take a risk. Because once it's there, it's very sticky, very hard to get around, because the mechanisms of, I will call it inertia, but just inflation just feeding into the future, into wages and wages into prices, and then you get this wage inflation dynamics is much more complicated. And the more historical inflation a country has, the more in the back of the mind they have. So countries do not take the risk. And the second is the independence issue you are mentioning, which is if independence is not at stake, you'll take your risks and take your time, and you have credibility, and you'll use your stock of credibility, your capital accumulated to take your time. But if independence is always questioned, and like it is the region, you don't want people to say, well, inflation is high because the central bank did not act, and it did not act because there was election in year X or in year Y. So you need to act. So I will say that both from structural inflation and expectations, central banks react faster. And second, independence is always, de facto independence is always at stake. So you don't gamble with that.
Let me ask you very quickly as a sidebar on Brazil tomorrow. You think 150 basis points is fast enough, or we should be, the central bank should be doing higher, faster?
I think 150 basis points per meeting, and you have 40 days between the meetings, is fast anywhere. It's just not fast with the market in Brazil, where people are getting anxious. And to be honest, I think the central bank somehow entered this game of giving the markets increases in pace when maybe you should just take your pace. I always say that central banks have to be more serene than markets. Markets are always, at least my experience was that they always want to increase fast and reduce fast, and if it didn't work, they will say, well, that's the mistake of the central bank. They reduce too much, or they increase too much. But at the end of the day, if you do the pendulum, which is go too much or reduce too much, at the end of the day, the real economy does not change minds so fast as markets. And you have to take care of the real economy, goods market, even inflation. That's a more low frequency than what the markets have in mind.
Shantall, with this outlook, what are you recommending Goldman's clients? What investors should be doing?
Thank you, Juan Pablo. So let me just take a few moments to describe what's happened. In the past few weeks, we've seen the market get concerned about COVID and higher inflation. And the risk about higher inflation is that it worries investors that we could see pressure in interest rates. And given that valuations are high, it could derail equity markets. But we think there is room to maneuver before the level of interest rates in the US becomes a problem for the market. And actually, historical data suggests that in an environment of slowing but still positive GDP growth, the equity market has managed to deliver mid-single-digit returns even when real rates are rising. So what is important to remember when it comes to the outlook for US equity markets is that the economy is growing above trend. Savings within American households are high, and we have seen a very successful vaccination campaign in the United States, which shows that the US preeminence theme is still very strong and pretty valid. And we continue to recommend our clients that they stay overweight US equities over EM equities. We think EM will struggle to navigate its own structural fault lines, slowing growth in China, and I'm sure we're going to talk about that, and the Fed tightening policy, as we mentioned in a few remarks before. And so in effects, we're currently favoring a pro-dollar stance. We actually have had this approach throughout the year, and we have expressed it against the euro, the yen, and the Swiss franc. And just to provide some background on this, because I know the US dollar is a key question when you're building EM portfolios, at the end of last year, our work suggested that dollar bear cycles on average stabilize at similar drawdowns to what we saw last year. And so we thought that the downside from there was quite limited. And from here, we continue to see upside to the dollar on the back of policy divergence vis-a-vis other developed economies, capital flows that should still advantage the US and the US dollar. And here what I mean is that we continue to see positive dynamics within portfolio flows and hedging flows coming to the United States. And the last one would be that we still don't see very big positions or overly crowded positions within US dollar. So in a nutshell, we believe that the strength seen in the US expansion justifies to remain invested in US equities, especially during US expansions. We have observed around 87% odds of positive returns and higher odds of larger returns related to large losses.
We're going to go back, obviously, to the issue of China because it's crucial for Latin America. Gerardo, what you see, what are you guys recommending your own clients at BlackRock?
Well, what we're seeing is that the most important dominant trend when it comes to investments in the next few months is a full reopening and sort of the cyclical dynamics that come with that. There are still many segments of the markets that have been lagging behind quite significantly, especially sort of those sectors that are supposed to sort of perform well in cyclical upturns. Industrials, energy, we're seeing like even an idiosyncratic positive shock to energy markets. And one wonders then that if you look at some of the components of the market that have been lagging behind and have a lot of catch-up to do, what is it that we should expect? And what is sort of the role of Latin America as an investment destination in this respect? If you had, let me just do a quick sort of a context point here. If you had invested $1,000 in Latin America in the past 10 years ago, right now you would have $750. If you had put those same $1,000 in the US equity markets, in the S&P 500, you would have right now $4,450. So one may be tempted to say, okay, this is the time sort of to put money to work in LATAM because there's going to be the catch-up to do. Alejandro Werner already mentioned a lot of sort of the constraints and the structural reasons why the region has underperformed so massively. The way we like to see sort of the information of prices as it relates to the macro environment is that asset prices have a significant information content of the future fundamentals of the region. So it is probably that the markets are telling us that the future is not looking great. COVID accelerated some of the trends that have been going against the region. Unfortunately, some of the structural reforms that Alejandro himself mentioned on education, competition, and things like that are a necessary condition to be able to compete with other areas of the world that have been attacking the opportunities that the technological development have opened up. And here it is a sort of a case in point where LATAM as a region has been lagging behind. We want to talk politics. Politics, unfortunately, are not helping that much. So you put all of that in context, And I would agree somewhat with Shantall that US equity markets still have some way to go in the next number of months, perhaps more on the value side of the market, on the cyclical areas of the market. That may be the best way to play this full reopening dynamics that we're going to observe.
Thank you. Shelly, you mentioned before that you guys didn't take action yet on the inflation spike, right? But we saw in the last two years, several events of sovereign defaults. We saw obviously Argentina, Ecuador, some smaller countries like Belize and Suriname. So I wonder how you see the evolution in the next year, 2 years, given all the constraints that we're discussing, including all the political drama in certain countries.
Yeah, I mean, I think just to put it in context, I mean, we've seen a very ugly 2020, right, in terms of the downgrade scenarios. And that's been a global picture. I mean, I'm talking about well over 50 downgrades, globally. And Latin America has suffered quite tremendously during that period. We've, as you said, we've seen debt restructuring, but even in investment grade space, every country in investment grade space, with the exception of Uruguay, has been actually downgraded during the pandemic. And right now, we still have about 6 sovereigns in Latin America that are on negative outlook, so about 32% of the portfolio. With the exception of Brazil and perhaps Uruguay, most of the other ones are really smaller countries in the Caribbean and Central America. So I think, with the downgrades that we've done, you could kind of say among the major markets, perhaps we've seen some easing of, the downgrade cycle. Now, how the ratings evolve in the next 2-3 years, I mean, I think that's really going to depend on 3 main things. One is going to be the growth profile of the countries. Second will be fiscal consolidation efforts. And third would be how the political economy really works to influence the first two. So I think on the growth side, I mean, just very quickly, I mean, it's been a pretty good year for Latin America, actually, with growth still in the region over 6%. We think some of the tailwinds that we saw in the region this year will probably become headwinds. We are going to see US slowing down. We're going to see China slowing down. This might have implications for commodity prices as well. We're seeing domestic tightening of policies, both on fiscal but also on monetary that we've discussed. So, and the gains, the base effect gains that we're going to get are not going to be that huge. So we're really talking about growth between 2 to 2.5% going into next year. And then I also take the point that Gerardo mentioned about, there are really no sparks out here in terms of the growth story in the region, no structural reforms that is on horizon. But I would argue that we're actually seeing, things which are actually taking Latin America or the region a little bit backward. We've seen Mexico actually, undermining some of the structural reforms that were passed by the previous administration. We've seen a new administration in Peru actually, talking about renegotiation of contracts. Brazil was a bright spot in the beginning of the year, perhaps is no longer going to be such a bright spot with the election on the horizon. So the growth profile story is going to be very, very important to look at. The second thing on fiscal consolidation, the fact of the matter is that fiscal deficits in the region, despite the consolidation that we're seeing in the region this year, are still very high. We're talking about Latin America's median fiscal deficit to be around 4.5-5% GDP, even in 2022. So the pace of consolidation is probably not fast enough. So I think here, politics is going to play a big role. We're not seeing too many tax reforms. The negative demonstration impact from Colombia on that regard has probably slowed the country's propensity to actually pursue such reforms. Budget rigidity is already high. In some cases, are growing. For example, in the case of Brazil. So I think very hard to see that fast fiscal consolidation. And I'm sure we'll talk about politics because we do see several headwinds there coming from either potential social mobilization because of the social scarring the region is seeing, to political fragmentation, institutional clashes, elections that are coming in next year. So all these will cloud the policy environment and reform outlook in the next couple of years.
Thank you. We definitely going to talk about politics. I'll leave it for the last question. Before going to Ilan, I remind the viewers that if you want to ask questions to our 4 panelists, please send them over. and I'll read them at the end. You mentioned growth, and that's what the numbers are showing is that we had that rapid recovery this year after the COVID in 2020, but the outlook for next year is pretty grim. It looks like Latin America as a whole is going to grow 2% from 7% this year. Ilan, how close we are to be in this situation of stagnation or stagflation or even a recession, as we saw, at least very mild, but happening in Brazil?
I think one of the main problems in Latin America, and that's not only Brazil, talk about Mexico and other countries, is that in the last several decades, you were not able to grow. Certainly, you were not able to converge to advanced economies. Some countries did, there are always exceptions. When I mentioned inflation going down, of course, there were some countries that did not have this inflation. And there are other countries more successful that managed to grow more, but the region as a whole has disappointing growth. We had a crisis, it was a COVID crisis, a big decline. And then once mobility was back, either because people had to come back to the market or later on, vaccinations and doing better in terms of the COVID issues, you recover. Some people will not like to say it's a V-shaped recovery, it doesn't mind what you call it, but we saw a big decline and a rapid comeback. But now when we look at next year, some countries are just getting back to their normal, dismal rate of growth. So we are disappointed with the forecast for 2022, basically because we are disappointed about the growth forecast for Latin America in the last 20 years. In addition to that, you have countries like Brazil that are tightening monetary conditions. Financial conditions are going to be very tight, and a deceleration even below the small rate of growth, potential growth. So if it's 2%, it's closer to zero, because there's no way you could fight inflation of 2 digits without breaking the eggs. You'll have to somehow get a deceleration. The risks in Brazil is that beside the deceleration, you have an election next year. And you also have the issue we just discussed recently, which was US financial conditions. If, in addition to a very polarized election, you have tight global conditions, then the 0% becomes negative. And then you get a small negative rate with very dismal growth somewhere else. And the region is basically having very low growth everywhere. So the combination of steady low base growth with disinflation needs is bringing you a very low forecast for growth next year. And you mentioned disinflation, you mentioned stagflation. It's not stagflation in the sense that you grow, you have high inflation with stagflation. This case is more like always when monetary policy tightens, you first get the deceleration in growth while inflation is still high, and later monetary policy is able to reduce rates. So in the interval, it looks like a stagflation, it looks like deceleration with still high growth. It's basically monetary policy working with lags.
Shantall, can we count on China to help Latin America a little bit on that front? Not even?
Unfortunately, not. All right. So I think China is the biggest question mark for next year. Now, this year, we've been surprised by the lack of a more forceful response from policymakers to address the slowdown in the economy. And this leaves us questioning if what you need to see for policymakers to be more aggressive is an even steeper slowdown to what the market is currently expecting. But let me take a very quick step back and provide some background as to what happened this year. The slowdown that we have seen this year has responded to a source of or repeated series of COVID waves and tighter policy stance. Now, when I use the word policy, I'm referring to fiscal, monetary, energy, credit, property, regulation. Just policy was tight all across the board. And we have started to see policymakers begin to marginally relax this tight policy mix. And we do expect additional support into 2022. However, the measures that we are likely to see will probably be targeted and will focus on avoiding a buildup in leverage in the system. Therefore, this will soften, but will not prevent the slowdown that we expect for next year. So at the moment, we are expecting the economy to grow at a pace of around 5% for next year. Now, with regards to the Chinese equity markets, we still find it expensive. It is actually one of the most expensive equity markets in EM, and only India is screening slightly more expensive than China. And as you all know, this year, equity markets in China were clamped down by the tightening of this regulatory environment that I'm mentioning, especially within internet companies. And unfortunately, we have continued to see tighter regulation among the internet sector, and this is likely to keep sentiments low. And so you ask, if LATAM or EM is going to benefit from China, and the answer is likely. But the question should also be, what about commodities? And just let me provide a very brief overview. We are still constructive on commodities. We're still constructive on oil, more neutral on copper. And let me just walk you through what we think is important to keep in mind. In oil, we have seen a very strong recovery in demand. And given the very responsible and very measured supply response from OPEC, inventories have been drawn down. And this has supported prices and time spreads. Now, the outlook for copper is a little bit more neutral, as I had mentioned, because of the China situation. Now, we are seeing increased demand in decarbonization and electrification, and this with insufficient mine investment has created a very positive long-term environment for copper. But we're currently really cautious because of the headwinds that are coming at us from the Chinese property sector.
Thank you, Gerardo. You mentioned in the previous answer, what the asset price of LATAM assets are flagging, right? So do you think they are already incorporating this scenario of 2% growth? Do we have space for a surprise? And how worried are you by those forecasts?
Unfortunately, there is nothing in particular in the investable horizon that may trigger an upside surprise on economic activity, and on the back of that, asset prices could sort of outperform. The only thing that is also true in the region is that, notwithstanding the positive terms of trade shock that we've observed already with commodity prices pretty much across the board going up, and in particular energy, notwithstanding that currencies in the region are probably the weakest throughout the world. So if anything, in this environment of positive cyclical dynamics going into full reopening, there may be some short-term catch-up that some asset prices may do. Like Brazil, you look at Brazilian equity prices in dollars, and they're probably the worst performer around the world since sort of COVID started. Now, going forward, the one aspect that will continue to dominate, we think it's going to be technological innovation. Both, say, the inflation dynamics that have prevailed in the past 20 years that we were discussing before, to a very large extent could be explained by all these technological developments. And if you look at equity market opportunities, sort of the best investment performance has been driven by the innovations in different sectors. One intersection, which is interesting, and we've been spending time going back to the Chinese example, is that intersection of technology and the energy transition agenda. The ESG agenda, energy transition, environment is a structural, relatively new component in asset prices that we need to take into account. And wherever you can find those intersections, that is an interesting area to poke. There is, however, a complex geopolitical environment in all of this. Not only the Chinese regulatory initiatives that Shantall already mentioned, we've been somewhat surprised by the way that, notwithstanding the relatively steep slowdown in Chinese economy, the crackdown in different sectors, there hasn't been that much negative spillover around the world, and the outlook for the cyclical recovery is actually quite strong. But you look at what's happening, say, in Russia and Iran and sort of China, then one needs sort of to wonder how financial markets are going to be able to navigate a complex 2022.
Shelly, let me ask you about the two biggest countries in the region, the two biggest economies and creditors, Brazil and Mexico. Both posted contractions in the third quarter in the economy. How constructive are you for the credit outlook of these two countries next year in this situation of low growth?
Yeah, first of all, I would say that, both countries are rated quite differently, right? Mexico is rated low investment grade, and Brazil is, rated 3 notches below at BB minus. The other big difference is that Mexico, carries a stable outlook, whereas Brazil carries a negative outlook. So, again, and the final big difference is Mexico is actually been downgraded twice already in the last couple of years. Whereas Brazil's ratings have proven to be more resilient so far, partly reflecting that just a very low starting point of the rating itself, which was downgraded several times during 2015 to 2016, for example. Now, I think in the case of Mexico, this growth rate, which is your growth potential, is already very weak. It's kind of already incorporated into our rating. We've already taken some negative rating actions, as I mentioned, both because of contingent liabilities associated with Pemex, but also because of micro interventions that we've seen, by the Obrador administration. And the impact that's had on investment sentiment, for example, and as well as investment. I mean, I think that even before the pandemic hit Mexico, the investment environment had already turned negative. We had already seen an investment contraction in the case of Mexico. At this point in time, we're still pretty comfortable with our low investment grade on Mexico, just because we've already incorporated some of the negative news in our rating downgrades. Also, just to point out, fiscally speaking, Mexico's had a very different response to the pandemic. And now as we recover from the pandemic, what we're seeing in Mexico is quite contrary to what we've seen in other countries, a pretty small fiscal deficit. So the fiscal balance sheet has been better protected. We're also seeing debt more or less stable at this point in time. So for us to get more negative on Mexico's ratings, I guess, we would have to kind of consider, a scenario in which we're seeing, for example, more and more micro interventions, less and less of investment and growth. And we begin to reevaluate then the positive notch that we give, a qualitative positive notch that we give to Mexico for its long history of disciplined policies. Now, in the case of Brazil, on the other hand, as I said, it's on a negative outlook. And in Brazil, this continues to reflect actually, downside risk to the economy, public finances, and debt that we're continuing to see from this recent tinkering of the fiscal rule itself, the spending anchor, some issues related to the judicial claims or the precatorios as well. All this has meant tighter financing conditions for Brazil. In 2021, actually, we've, the starting point for 2021, we saw like the economic reopening growth at around, just around 5%. We're seeing external resilience, really seeing progress on vaccination as well, better fiscal numbers that are also coming through in Brazil for 2021. But we do think that economic and fiscal scenario will be definitely much more challenging in 2022. Ilan's already talked about, possibility of a mild economic recession in Brazil. So going forward, I think we're looking at ratings for Brazil. We'll really be evaluating, on the one hand, the progress already made on fiscal consolidation, through the pandemic, against some of these, outstanding risks that we see in 2022.
We have about 10 minutes to finish, so let's talk politics then. I'm gonna make a question for everybody. Even for people that have been watching Latin America for decades now, it's really astonishing what's going on. A few of the political reactions that we're seeing, the election in Peru this year, what's going on in Chile. Ilan, what are your big thoughts about politics? How the policy answer is working in Latin America?
Well, I think politics and politicians are in a tough spot. This is because the decades of low growth, but now they are facing social demands after some improvement in poverty and income distribution. But looking ahead, the perception is that much of the benefits and improvement is behind us. So there are social demands, low growth, and on top of that, you get COVID. So it's a very, very challenging situation. In addition, what we have is globally, not only in Latin America, a more polarized societies, people go to the extremes. So we cannot say that these polarized elections is just in Latin America. I think there are components, low social mobility, very high inequality, low perspectives for the future, but we need some answer that goes beyond Latin America. And it has to do with some sequels from the digitalization and social media and all of that goes beyond Latin America. So as usual, you get the external conditions affecting Latin America, but then we give our own sauce to that issue. So we get polarization, but then we got these huge polarizations everywhere immediately in Latin America.
Shantall, how you seen all the things?
I mean, I agree with everything Ilan said, and let me just try to also pull some stuff of what Gerardo said. So I agree that the cyclical recovery, for example, is still valid for the US or maybe other developed economies. It's not valid, or I don't think we're going to see a catch up in Latin America because of the cyclical component, because I think this is behind us. I think the narrative will shift towards the structural growth model and whether this model is well equipped for the post-pandemic era. And the experience from this year and from many other times in the past is that politics in the region tend to detract rather than enhance the structural growth model. And this is where Latin America screens really poorly relative to other regions. When we bring politics into the equation, the outlook gets very complicated than what a cyclical recovery would entail. So to me, the question is, how do you lift the binding constraints in some of these economies? And let me provide two examples, and you'll see how the political outlook just complicates lifting these binding constraints. And in Mexico, for example, the usual binding restrictions will continue to shape the country's growth profile, and they are lack of public investment and lack of private sector investment. And optimism is not warranted unless we form a view that whoever takes over in 2024 is going to be a little bit more pragmatic. And then maybe with a little bit of pragmatism, you can loosen up some of these binding restrictions. I'm not very hopeful. And in the case of Chile, because we haven't really talked about Chile, I think the binding constraints to growth seem a little bit to live than maybe Brazil or Mexico. The main source of soft potential growth is political and institutional uncertainty. And some of this uncertainty has been addressed by the outcome of the legislative elections, for example. And I do think that Chile has the ability to grow at a higher rate than the rest of the region. But if we have learned anything from the past few years, is that we need to see social programs come hand in hand with growth in this country. Now, there are some characteristics about the Chilean recovery that are similar to other small and open developed economies, and there's a lot of momentum in the Chilean economy. And so that's why I'm a little bit more hopeful, because loosening these restrictions a little bit could go a long way. And this would also come at a time in which Chilean equities are the cheapest EM equity market in the whole universe. But again, when you look at Chile, and coming back to your question on politics, we recognize that it looks cheap, but the degree of uncertainty builds a case for some of these valuations to trade at such large discounts. So from here, it's all about lifting uncertainty for the region, and it's going to be complicated.
Gerardo, you know, a lot of these politicians in the region, are they reacting logically to this situation? Because as Ilan says, you know, it's a tough one, right? Like we are here seeing it from outside. If you're president and you need to deal with COVID, how you do it?
Well, the behavior of
right?
the behavior of politicians in the region is no different from what we're seeing in other areas of the world. We are in an era of like social media and social platform politics, which provide politicians to connect more directly with individual voters, and that drives some of the behavior that we're seeing across the board. Now, this behavior is particularly worrisome in the region because of everything that we've discussed, that the level of institutional development that we observe in Latin America lags significantly other countries with similar GDP per capita levels. So we've seen that institutions are being tested as we speak. And one remarkable aspect of this is how well, I would say, the central bank institution in the region has been able to withstand the current challenges. But that's not true across the board. Now, in an environment in which there's a lot of self-inflicted pain, where political decisions have led to lower potential GDP growth, eventually, since we live in a democratic environment, eventually the electoral cycle should correct a course. To the extent that there's electoral accountability, that should be able for the whole system to self-equilibrate. Here is where the institutional strength or lack of strength thereof becomes important. And it is an area in particular in those countries that are about to have electoral processes where it is particularly important to pay attention on how electoral institutions are able to withstand potential attacks on the back of negative results for seated politicians.
Shelly, do you see in all this situation any erosion of the willingness of governments to defend their credit ratings, their interest in talking to the rating agencies? We saw a very interesting case of Colombia this year, right? The government trying to do everything possible to protect the investment grade. They lost it in the end, and you know they almost had a political crisis on the way. How you analyze all that?
Yeah, I mean, I think I would first say that, you know, the engagement that we've seen with different governments, you know, whether they're going into elections or whether they're trying to stabilize, you know, the tricky or complicated fiscal picture, you know, has remained relatively high. I mean, I think that, you know, countries, you know, have not shied away from, or governments have not shied away from, you know, discussing the constraints that they face, you know, at this point in time, the very tough trade-offs that different governments have to make. But at the same time, I think, you know, we should sort of emphasize that, you know, there has been relative transparency, you know, through the process. You know, countries have been generally transparent about the constraints that they're facing, even with, you know, market participants. So I think in that sense, you know, I wouldn't say that that's been a very big negative surprise during this, you know, pandemic crisis. Now, that said, I think, you know, politics, as I mentioned earlier as well, I mean, I think that, you know, transparency is one thing, but kind of delivering on a very tough fiscal consolidation process ahead is going to be something very different. And here, you know, what sort of, what elections bring, you know, whether there will be any negative surprises or not, you know, remains to be seen. You know, we obviously have, you know, elections coming up in Chile, for example, you know, where, you know, the two candidates that are in the second round, you know, offering very different policy prescriptions. We see, risk actually from both sides, in terms of their policy prescriptions. On top of the elections, you also have the constitution rewrite process going on in Chile as well, which will also actually increase fiscal burden. You could see more enshrining of social rights in the constitution drafting process. So I think we are kind of waiting and seeing on how things evolve after this election cycle. Whether the new governments are able to crowd in private investment, help confidence, but also what they're able to really deliver on in terms of fiscal consolidation.
They're telling me we have 5 more minutes, so I'm going to give you 1 minute each for final remarks. If anybody wants to give us some hope on the horizon for next year. Ilan?
Well, I'm not sure I'm going to give hope. What I can say is that there is big homework to do. Latin America needs to deal with the fiscal, monetary issues, social issues, and structural growth issues, and they have to do it. Latin America has to do it simultaneously. There's no more time just to say, let's just deal with the fiscal issues, debt, sustainability, forget about social, forget about growth. You won't get there. So I think there needs to be another mentality where you have to deal with what you get. It's not going to be easy, but I believe that there's a lot of still room for maneuver.
Shantall?
Juan Pablo, I will just say that hope is not a strategy, but I'll try to provide I'll try to provide a more positive tone to end this. I think the shift in the Fed narrative shows that this is a very responsible central bank that is not going to be behind the curve and that is willing to address the inflationary outlook. But we also think it's not a central bank that is going to sacrifice and crush growth, and therefore we don't expect a massive tightening on financial conditions. And despite the fact that we have seen over 100% returns in the US since the market bottomed in March of 2020, past economic expansions suggest that there is still further upside from here, even after seeing these massive gains. So when we put it all together, we recommend clients that stay invested and that remain overweight US equities over EM equities on this very resilient outlook in the US economy.
That's not very hopeful, I have to say, for that. Gerardo, your turn.
Two quick comments on this one, Pablo. One is that, as I was saying before, the market backdrop is likely to continue to be quite positive for the investable horizon. And in that environment, there's a potential that asset prices in the region actually perform well and can do some catch up. I already mentioned some of the positive terms of trade shock that are not necessarily reflected in asset prices as well. So that's a sort of a positive sign in all these negative, otherwise negative context that we've discussed. And the second one, it is becoming so evident the underperformance of the region in almost any metric that you can think of across the board around the world, that hopefully from this challenging situation and becoming again even more evident for the general population, that there can be like some reaction to that triggers some change. It is unfortunate that because of COVID, there has been some sort of a reset. Some of the things that Shelly mentioned in terms of like the ratings, it's just kind of hard to compare in the cross section given the massive shock that you had. It is something that may start to happen in 2022. And again, in the context of so large of a long-term underperformance of the region, hopefully we can see some leadership emerging with sort of the type of medicine that we've discussed would address the challenges that we have.
And Shelly?
Yeah, I mean, it's very hard to, kind of put a positive spin on things after we've talked, quite cautiously about the region so far. I mean, I think one thing I would say that, even on the inflation front, at least the central banks are making an attempt to kind of, stay with the, trying to fight the expectation, or de-anchoring of expectation fight, right? So I think that is, trying to stay ahead as much as they can of these inflation pressures. Hopefully, you will see some easing of these pressures next year. Second thing is more of a hope that pragmatism sets in under new leaderships. After the elections of next year. We're not obviously here forecasting what different elections will deliver, but given the needs of the region, perhaps if we see greater pragmatism, that would help. And on the issues side, I mean, financing constraints, this was an issue quite a bit in 2020, for some of the countries. Hopefully we are not entering, any dramatic tightening of financing conditions, and hopefully they are orderly, and in that case can be, absorbed. And finally, I would say that smaller countries, that already are under the IMF program, for example, Ecuador, Costa Rica, for example, progress, seeing IMF as an anchor to kind of do some of the needed reforms, could, help over time, boost, confidence in some of the smaller credits in the region as well.
All right, maybe we don't see a lot of growth next year, but hopefully we can see the region coming out of the COVID crisis, and we can all be healthy, after these terrible 2 years. I want to thank you, Shelly, Shantall, Gerardo, and Ilan for this conversation. Thank you, the guys from Eurasia, from organizing it. I learned a lot, so it was very, very great to be your moderator. Thank you.
Thank you.
Thank you.